Hi guys, welcome back. Every investor dreams of catching the next compounding machine before it takes off. Well, Zoetis did already take off and crash. Over the last year, they lost 18% while the S&P surged by 20%. But the fundamentals are still booming. Revenues are growing, the margins amongst the highest in the industry, and even their dividend is at a 10-year high. So what is happening? Is Wall Street sleeping on this one, or are there hidden red flags no one is talking about? In this video, we dive deep into Zoetis' fall from grace and why this dip might be a huge opportunity for investors. Because the numbers, they don't lie. And if you're new here, my name is Florian. Thank you for joining me today. So, over the last year, Zoetis stock has dropped by 18% and has underperformed the S&P 500 that has returned 20% in the same time by quite a bit. But despite this drop, the performance of the stock and the index is still roughly on par when we zoom out to 10 years. And until the recent crash, Zoetis was actually ahead in terms of performance. And this strong long-term performance is hardly surprising, because the company could consistently grow faster than the general animal health market that could grow with 5% annually. At least according to the information from the company's own presentation. But you know me. I'm a skeptical little guy and this kind of statement triggers my suspicion. So I'll for sure have a look at the growth and the market later, but first, let's understand how the company even earns their money. Zoetis is the world's largest pure play in animal health. Since their spin-off from Pfizer in 2013, they have been serving veterinarians, livestock producers and pet owners. I have to give a brief trigger warning now because I'm gonna butcher a bunch of words and probably add a strong German accent. It will not be pretty, because its portfolio spans vaccines, parasiticides and dermatology therapies. But they also provide solutions for diagnostics, genetic testing and even biodevices. With these products and services, they are first aiming to predict and prevent animal diseases, but also to detect and treat illnesses. The majority of their revenue, namely 68%, comes from companion animal products, while the remaining 31% are from livestock products. And even though Zoetis themselves are only active as a standalone company since 2013, they already have 70 years of experience in this sector as a former part of Pfizer. And with this long experience and a strong focus on R&D, they did develop over 2,000 new products in the last 12 years, over 300 different product lines for 8 core animal species. With these products, they are active all over the world, although the majority of their revenue, namely 55%, comes from the US. And that they indeed do have a strong portfolio also shows in that they have managed to become the market leader in many of their focus areas and geographies. And by the way, my two cats, Jimmy and Ray, agree with today's analysis. They've owned me for over a decade now and might be thrilled to meet you, if you bring treats. But back to Zoetis. So they are pretty strong in this animal health market. And the market itself is also a very interesting one with several ongoing trends that are driving the growth here. For example, the expenditures on pets in the US has grown significantly over the last couple of years. This trend is driven by more and more younger people owning pets. In 2020, households headed by younger generations accounted for roughly 60% of pet ownerships, while households headed by baby boomers accounted only for 30%. And especially millennials and Gen Zs are willing to spend significant amounts of money not only for health treatments, but also for preventive care. These trends were only further increased by the COVID pandemic that forced many people to stay at home for longer periods. And the recent outbreaks of the bird flu virus in dairy cows and the expansions of several parasite risk zones like the heartworms or ticks are pushing the need for better care for livestock and cattle. AI-based analytics are also transforming livestock management like health and nutrition monitoring to prevent diseases and improve the yields. Zoetis is already providing some products, especially for veterinary diagnostics here, like this disposable self-contained cartridge that is used to perform an automated blood count that can reveal critical information about underlying conditions such as anemia, inflammations or infections. These developments should help the market to grow by around 7% annually until 2032. Now, the estimation for the market growth in this sector varies quite a bit. And in my research, I found values that range from as low as 4% annual growth to growth rates of even over 10%. So please take this with a grain of salt, the uncertainty here seems to be rather large. But even the most pessimistic forecasts still expect a growth rate in the mid-single digits. Zoetis themselves expect a market growth of around 4% per year until 2033. So they are forecasting rather conservatively, which brings me back to the graph from earlier, where they claimed to have grown significantly quicker than the market. And with what we learned now, these numbers definitely look realistic and might even be on the conservative side. I do like this conservative approach much better than an overly optimistic forecast. Because I'd rather have my investments to surprise me with positive news than with negative news. And of course, all of these expectations also come with risks. For example, there are some strict regulations in the EU to decrease the use of antimicrobials by 50% until 2030, which could affect the livestock business of Zoetis. The competition, especially in the dermatology market, is also rising. Just a couple of weeks ago, the European Commission approved a new treatment from Merck here. And another treatment for skin diseases for dogs was approved by the FDA just last year. This probably won't kill the business for Zoetis, but at least it has the potential to erode the prices here. And because this is one area where they are currently the market leaders, it could also erode their position here. But of course, despite these risks, the secular trends are still solid, and the strong focus on R&D and close customer relationships should help the company to further grow. For this year at least, they have performed better than expected, which has helped them to raise the guidance for the second time this year already. And even though the raise this time is not so big, it still shows that the company has room to grow. And speaking of growth, let's have a look at how the company did financially in the last few years. Income-wise, the company could grow all metrics that I track in my dashboard very nicely over the years. We have a strong top-line growth in revenue that translates to even higher growth in net income and free cash flow. This shows a strong market demand for the products on the revenue side, but also that the company is able to effectively manage their cost and margins on the net income side. So all in all, it is exactly the picture I like to see for my investment and shows every sign of a healthy compounder. In the last 5 years, Zoetis could grow their revenue by 8.2% CAGR, their free cash flow by 12.2%, and the EPS by 11.5%. These are all quite nice growth numbers that show that despite the drop in stock price since 2021, the company could still grow the fundamentals very nicely. And at the same time, they have also grown their margins steadily. We see a very nice growth over all margins here, with only the free cash flow margin fluctuating a bit in 2022, but still very close to the highest levels. Right now, they have a gross margin of 69% and an EBITDA margin of 42%. Oh, come on, Zoetis. You're making this too meme-worthy. Sorry, with a setup like this, I just can't resist my inner child. But either way, back to the margins. Their free cash flow margins sit at almost 25% currently, which is a whopping 20% above the sector median. And even the ROIC, which is one of the most critical profitability metrics for me, is with 22.7%, way above most other companies from this sector. They also have a pretty decent balance sheet with a net debt to EBITDA ratio of 1.3 and an interest coverage ratio of 12 times. That means that they can roughly pay back all their debt within a bit over a year and can cover their current interest expenses 12 times over. So their balance sheet is good, but not great. But it still leaves some room to take on further debt if an interesting acquisition comes their way. And with almost 2 billion in cash and cash equivalents, they also still have quite a nice cash reserve in their hands. And some of this cash is used to buy back their own shares. In fact, as of right now, they are in the midst of their biggest multi-year share repurchasing program ever that they announced a year ago as part of their capital allocation strategy. So again, we have a low net to EBITDA ratio of 1.3, an interest coverage of 12 times, and a share dilution of minus 1.4% that has even picked up speed in the last 2 years. This is very nice to see, but it is not the only way the company is rewarding their shareholders. They are also paying a dividend of 1.3% right now, which they could grow by over 20% per year for the last 5 years. And despite all this, the cash flow payout ratio is still at a very reasonable 34%, which leaves a lot of room for future growth, especially if they keep lowering the cost for the dividend payments by reducing their share count at such a speed. This dividend growth, combined with the decline in stock price, has also pushed the yield to the highest level of the last 10 years. And if you still think that this yield is a bit low, if you would have invested in the company 10 years ago at around half the yield we have today, by now it would have grown to almost 4.5% already. I am honestly a bit astonished that I didn't notice this company earlier. It seems to fit perfectly into my strategy and up to now fulfills all requirements that I have for my investments. But as usual, in order to determine if they are not only a great company, but also a good investment, we also need to look at the current valuation and the expectation for the next few years. And right now, the 14 analysts that offer a 1-year price target are pretty optimistic for the company. They see an average upside of 28% with basically no risk at the current price. The EPS should grow by 9.4% annually for the next 4 years, while their revenue growth should slow down to 4.9% annually. These rates, while still okay, are quite a bit below the growth rates from the last 5 years, which might again be an indication for the price competition for the company and the decline in stock price. But at the same time, this decline in stock price has also pushed the valuation down. Zoetis currently has a PE ratio of 23.7, an EV to EBITDA of 18, a price to cash flow of 22.3 and a PEG ratio of 1.8. This is all quite a bit above the sector medians. But when we look at their own 5-year history, we see that the valuation has also come down significantly during this time. The peak valuation was at the beginning of 2022, which also coincides with the peak in stock price. Compared to this peak, the valuation now is more than 50% cheaper and still around 1/3 lower compared to the 5-year average. So their drop in stock price is mostly due to the decline in valuation from their pretty exaggerated level. Nothing else. But if you think that the company is cheap now, please remember that it is still way above the sector median. Yes, they have also outperformed the sector, so a certain premium is definitely warranted. But still, cheap looks different. And while we're at the topic of sector median, before I sum this up and come to my conclusion, let's also briefly compare them to their closest peers. And if you find this video interesting, please subscribe to the channel and hit the like button to not miss my next video. I know it's a bit annoying that I ask this, but it really helps the channel and makes me very happy. And as a small thank you, I promise you to read and reply to all of your comments. And now, let's have a look at Zoetis peers. For the peer comparison today, I choose Merck, IDEXX Laboratories, Elanco Animal Health and Phibro Animal Health. These are the major companies that are listed on the stock exchange. But for completeness sake, I want to mention that there are also 2 major companies with Boehringer Ingelheim and Dechra that are not listed and the numbers are not so easily available. But from these companies, in the last 10 years, IDEXX had by far the best performance with 794% total returns. Zoetis comes in at 2nd place already. Our other 3 companies have actually underperformed the broader market by quite a bit, with Elanco even producing negative returns over this time frame. And not all of these companies are paying a dividend. Merck stands out here most with a dividend yield of 4%. Phibro just started paying a dividend very recently with a yield of 1.7%. And while Zoetis has the lowest yield of our dividend payers, they could grow it the quickest with over 20% CAGR in the last 5 years. In terms of valuation, IDEXX has by far the highest PE ratio that is even over double the valuation of Zoetis, which has the 2nd highest. And this is not only true for the PE ratio, but we also see a similar trend in the remaining metrics. But the PEG ratio shows an interesting picture here. IDEXX also has by far the highest one here with 2.8 in the trailing 12 months, while Merck and Phibro have a PEG that is significantly below 1. The PEG ratio puts the PE ratio into context with the EPS growth, and a PEG of 1 indicates that the PE ratio is roughly in line with their growth and therefore fairly valued. So these 2 companies currently have the best value for their growth, while IDEXX is priced pretty highly. And yes, the growth of IDEXX, at least in the bottom line, is also the highest here. But it is not that far above the other companies to warrant for the valuation difference. I have not looked very deep into IDEXX yet though, so I can't say if there are any other effects to warrant this valuation. The profitability is again where Zoetis but also Merck can shine. They both have similar values here and are both well above our other companies here. And while IDEXX can at least keep the rough pace, The other two companies fall behind quite a bit, especially in EBITDA and net income margin. So overall, there is a lot to like about Zoetis. They are a top player in a growing market, and this shows in their best-in-class margins and the growth that was quite a bit above the sector median in the last decade. I also believe that they have a good position with their portfolio to benefit from multiple secular trends, but that the competition is also rising. This also shows in the EPS and revenue forecast that is expected to be quite a bit below the levels from the last couple of years. And despite the valuation being way below their own historical values, it is still quite a bit above the sector median. But the stock could be interesting for dividend and dividend growth investors because the drop in stock price has also pushed the dividend yield to the highest level of the last 10 years. And when we also factor in the huge dividend growth and the low payout ratio, the overall dividend picture looks very tempting. But as always, that is just how I see it. And I would be really interested what you think about the company and the sector in the comments below. And guys, I am trying to be fully transparent with my investments and my investment strategy here on this channel. If this is something that sounds interesting to you, check out my latest portfolio update right here. And of course, this is no financial advice. So please, before investing, do your own research and only use this video as a starting point for your analysis. That being said, thank you so much for watching guys, and see you in the next video.